You've probably heard that countries like China and Japan hold significant amounts of US debt. But have you ever wondered what that really means and why they do it? When the US government needs to borrow money, it issues Treasury securities, essentially IOUs promising repayment with interest. Foreign countries buy these securities, effectively lending money to the US. But what's their incentive? US Treasury securities are among the safest investments globally. This is because the US government consistently repays its debts, and the US dollar is widely used in international trade. For nations seeking low-risk investment opportunities, purchasing US debt is a prudent choice. Many countries that export heavily to the US accumulate large quantities of US dollars. Instead of holding these as cash, they invest in Treasury securities, earning interest and stabilizing their own currencies. This strategy keeps their exports competitively priced and helps manage their foreign exchange reserves, emergency savings predominantly held in US dollars. Purchasing US debt also strengthens political and economic relationships. Investing in each other's economies fosters mutual interests and stronger international ties, facilitating smoother diplomatic relations and cooperation on global issues. But how often is this information released? The U.S. Treasury Department publishes monthly data known as the Treasury International Capital (TC) report, detailing foreign holdings of U.S. debt. This report identifies which countries are buying or selling Treasury securities and how much they hold. Data is typically published mid-month, reflecting figures from 2 months earlier. Recently, significant developments occurred between November 2024 and January 2025, when foreign nations significantly reduced their holdings of U.S. Treasury securities by approximately $390 billion. This global sell-off marked one of the most substantial reductions in recent memory, sparking conversations about international confidence in U.S. economic stability. Brazil led this shift, reducing holdings by $55.9 billion. Other major sellers included Ireland, $42 billion, the Cayman Islands, $41.2 billion, Canada, $37 billion, Norway, $35 billion, and India, $34.9 billion. Notably, even Japan and China, the largest holders, participated, each shedding $7.8 billion. Smaller yet meaningful reductions were made by countries such as Belgium, $10.5 billion, Switzerland, $8.3 billion, Luxembourg, $7.9 billion, Hong Kong, $7.4 billion, France, $2.8 billion, Germany, $0.5 billion, and Taiwan, $5.4 billion. This coordinated sell-off reflected broader concerns about U.S. fiscal sustainability, geopolitical tensions, particularly between the U.S. and China, and potential financial weaponization under the returning presidency of Donald Trump. Trump's America First policies, including protectionist tariffs and aggressive trade strategies, intensified global uncertainty. As Trump resumed office in January 2025, he quickly reinstated significant tariff policies, aiming to align U.S. tariffs with those imposed by trading partners. These reciprocal tariffs, set to begin April 2, 2025, represent some of the largest import tax increases in recent history. While intended to protect domestic industries, they risk raising consumer prices and could contribute to inflation, according to Federal Reserve Chair Jerome Powell. Globally, these tariffs are expected to disrupt established trade relationships. The European Union has expressed concerns and signaled possible retaliatory tariffs, mirroring strategies from past trade disputes. EU Trade Commissioner Ingrid Lauren specifically noted the potential targeting of iconic American exports like motorcycles, whiskey, jeans, and agricultural goods, a tactic previously used effectively during trade conflicts. China, already responding aggressively, imposed tariffs on U.S. agricultural products and hinted at further restrictions. These include tariffs on soybeans, pork, dairy, and corn, targeting politically sensitive regions in the U.S. Additionally, China has halted imports of several U.S. energy products and hinted at broader restrictions on automotive and tech components, as well as heightened regulatory scrutiny and customs clearances. Canada, similarly impacted, announced consultations for counter tariffs targeting approximately $125 billion of U.S. goods and planned to eliminate internal trade barriers to strengthen its economy against external shocks. Prime Minister Mark Carney even scheduled early elections to solidify Canada's stance amidst rising trade tensions. Canada's proactive measures aim to ensure domestic market resilience and reduce vulnerability to external economic disruptions. Certain sectors, such as U.S. agriculture and automotive manufacturing, face significant vulnerabilities. Agriculture, heavily dependent on exports, risks substantial losses from retaliatory tariffs, potentially devastating rural economies. Agricultural exports totaled over $170 billion in 2023, with major products including soybeans, corn, wheat, pork, and beef. Retaliatory tariffs could severely restrict market access, causing price drops and oversupply domestically, hurting farmers' incomes. Beyond direct exports, farmers face increased costs for essential inputs like fertilizer, steel, and machinery, primarily imported from Canada, Germany, and Japan. Smaller farms, particularly vulnerable, may struggle to absorb these higher costs, leading to consolidation or closures within the sector. Automakers, reliant on imported parts, could face increased production costs, higher consumer prices, and possible job losses, especially in automotive-heavy states. Industry analysts estimate that tariffs could add $1,000 to $3,000 to the price of new vehicles, reducing consumer demand in an already challenging high-interest rate environment. This potential slowdown threatens nearly 10 million jobs across the auto industry, particularly in states like Michigan, Ohio, and Indiana. Additionally, retaliatory tariffs from key trade partners like the EU, Mexico, and South Korea could further restrict export opportunities for major U.S. automakers such as Ford, General Motors, and Tesla, all of which rely heavily on international markets for continued growth. Ultimately, these developments reflect deep international uncertainty driven by geopolitical tensions, fiscal concerns, and protectionist economic policies. With Trump's return, concerns about the U.S.'s fiscal responsibility and international predictability have resurfaced, prompting many countries to reevaluate their long-term investment strategies. The cumulative effect of these economic shifts suggests a more fragmented global trade environment, potentially reshaping international economic alliances and investment patterns for years to come. Businesses and governments alike are closely monitoring these developments, planning strategic adjustments to mitigate risks and leverage new opportunities arising from shifting economic landscapes. What are your thoughts on these developments? Share your insights in the comments. Thank you for watching. If you found value in this content, please consider liking and subscribing to our channel. Your support greatly impacts our community. You can check out another of our videos displayed now on the screen.